Welcome to our channel, Stock Market Analyst. Today, we're diving into the basics of short selling. By the end of this video, you'll have a clear understanding of what short selling is, how it works, and the risks involved. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is short selling? Let's start with the basics. Short selling is a trading strategy where an investor borrows shares of a stock and sells them on the open market, hoping to buy them back later at a lower price. The goal is to profit from a decline in the stock's price. Think of it as betting that the stock price will go down. How does short selling work? Here's how short selling works. 1. Borrow shares. The investor borrows shares of a stock from a broker. These shares are typically borrowed from other investors who own the stock. 2. Sell shares. The investor sells the borrowed shares on the open market at the current market price. 3. Wait for price to drop. The investor waits for the stock price to decline. The goal is to buy back the shares at a lower price. 4. Buy back shares. The investor buys back the shares at the lower price. 5. Return shares. The investor returns the borrowed shares to the broker. 6. Profit. The investor profits from the difference between the selling price and the buying price, minus any fees or interest charged by the broker. Example of short selling. Let's look at a practical example. Suppose an investor believes that company XYZ's stock, currently trading at $100 per share, will decline in price. The investor borrows 100 shares and sells them for $100 each, receiving $10,000. A few weeks later, the stock price drops to $80 per share. The investor buys back the 100 shares for $80 each, spending $8,000. The investor returns the borrowed shares to the broker and keeps the $2,000 difference as profit, minus any fees or interest. Risks of short selling. While short selling can be profitable, it also comes with significant risks. 1. Unlimited losses. Unlike buying stocks, where the maximum loss is limited to the amount invested, short selling has the potential for unlimited losses. If the stock price rises instead of falling, the investor must buy back the shares at a higher price, resulting in a loss. 2. Margin requirements. Short selling requires a margin account, which means the investor must maintain a minimum balance in their account. If the stock price rises, the investor may receive a margin call and be required to deposit additional funds. 3. Borrowing costs. Borrowing shares involves paying interest and fees to the broker. These costs can add up and reduce the overall profit. 4. Short squeeze. A short squeeze occurs when a heavily shorted stock's price rises rapidly, forcing short sellers to buy back shares to cover their positions. This buying pressure can drive the stock price even higher, resulting in significant losses for short sellers. When to consider short selling? Short selling can be considered in the following scenarios. 1. Overvalued stocks. When an investor believes that a stock is overvalued and due for a correction, short selling can be a way to profit from the anticipated decline. 2. Negative news. If a company is facing negative news or events that could impact its stock price, short selling can be a way to capitalize on the expected decline. 3. Hedging. Short selling can be used as a hedging strategy to protect against potential losses in a long position. For example, an investor who owns shares of a company might short sell shares of a competitor to offset potential losses. Ethical considerations of short selling. Short selling has its ethical considerations. Some critics argue that short selling can contribute to market volatility and negatively impact companies. However, proponents believe that short selling plays a vital role in maintaining market efficiency by identifying overvalued stocks and providing liquidity. It's essential to consider these ethical aspects when deciding whether to engage in short selling. To sum up, short selling is a trading strategy where an investor borrows shares, sells them, and hopes to buy them back at a lower price to profit from the decline. While it can be profitable, it comes with significant risks, including unlimited losses, margin requirements, borrowing costs, and the potential for a short squeeze. By understanding the mechanics and risks of short selling, you can make more informed decisions about whether this strategy is right for you. That's a wrap on our guide to short selling. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!